Hey everyone, welcome back to Finance Bro University. Searching for the passive income dream, we are going to take a survey of the high yield ETF landscape in search of the ideal passive income and see what we can find. Finance Bro University is for the new paradigm in finance. We're going to master the old rules and then break them. We're going to take a look at the high income ETF landscape. We're going to categorize some of the ETF products that exist in the landscape. We're going to review their performance attributes and find some common themes amongst them. And then we're going to try and define true income and the implications for your search for that passive income dream. And I'm going to link my previous videos that are relevant to this video in the comments section. So if you are interested, go back because I do deep dive into some of the more interesting exotic high income ETF products like Misty and Winter. But this time we're going to go broad and we're going to look at the whole landscape and take away some learnings and see what we can find. So when we look at the high yield dividend ETF income landscape or market, we can categorize it into three main themes. One, full income focus, right? Characteristics are a maximum income generation at the expense of limited or no upside exposure and usually full downside exposure in the underlying asset that they are exposed to. Common themes would be Misty, Winter, Coiny, Alti, QQQY, FEPI, Who, or How, or however you call it. These things generate, a massive gross yield in the 50 to 80% kind of range, but they generally have a NAV erosion that's attached to them as a byproduct of having that full downside exposure and that limited or no upside exposure. The other sort of category is we have structured yield. These are sort of balanced income generation through a more disciplined approach to call writing, right? So JEPQ, JP Morgan's NASDAQ Equity Premium Income, DGIA, JEPI, GPIQ, XYLD, PCEF. These products balance the income generation through being very tactical in how they employ like a call writing strategy, much like the full income focused products, but usually try to keep some of that upside exposure in while balancing the income generation that they generate as well. And then we just have our standard income-orientated value investing kind of products. Your Schwab US Dividend Equity ETF, your Vanguard, your iShares, your SPDR, Divi. These products have that diversified income from dividend-generating equity investments, right? Your stocks in like utilities or durable consumer goods or necessities, your supermarkets, your power stations. Super boring, nice income generating assets that are diversified and you're not exposed to any individual risk of a specific company. And these are the general categories that we can see in the market. And what we can do is categorize their performance across a couple key metrics, which we'll do now. Right, so when we review this high yield dividend ETF landscape or this overall dividend ETF landscape, we get the three categories and we look at the gross dividend yield and the total return. And I've done this on a since inception basis just so that it's comparable for everyone because some of these have existed for a year, some of these have existed for a few months, and some of them have been around for a long, long time. But we can see some really interesting characteristics, right? So we've got our full income focus here. We've got the high gross dividend yields. We're like, oh yeah, 80, 90%. Oh, Coney, 140%. Amazing. And we see this is like an amazing passive income opportunity, maybe. And then we have our structured yield products that sort of sit at that low double digits space, 10 to 14% sort of area. And then we have our income-orientated value investing, which sit at that boring 2 to 4%. You're like, well, I'm not going to retire anytime soon. I'm going to have a few $1 million based in these products before I can retire. So thanks, but no thanks. So let's generalize for a minute. So if we look at the average of our full income focused products, we have an average yield of 83% and an average total return of 57%. But I caveat this when we exclude the Bitcoin-oriented products, which have a yield of 33% and an average of 15%. And what you'll see is that the total return is much lower than the gross dividend yield, right? And I'm going to park the excluding Bitcoin assets for a minute. And the reason for that is that the Misty, Winty, Coney products are benefiting from a very, very specific thing. That is this once in a generation monetary event where Bitcoin is monetizing underneath them and they are then taking that volatility and converting it into income in a way that's really interesting. And I will probably do a video devoted to them specifically. because there are narrow sets of scenarios where owning those products could be a great idea, but there's also some seriously wide probability aspects in which owning these products could be not so great. So we'll probably deal with that in a separate video. So generally, if we look at it, we've got a 33% gross yield and a 15% total return, which when we look at that is not a lot different to our structured yield products that generate about a 10.8% dividend yield and a 10.2% total return, which means that the total return and the gross dividend are broadly parity or the same, right? Like the capital is generally holding its value nominally and paying you out a 10% dividend income. And we have our income-orientated value investing. Now, what we see here is very interesting. We have a gross dividend yield of maybe 3.2%, but we have a total return much higher. We have a total return of 9.5%, which means that there is a capital appreciation occurring within these products. And when you factor that in, they're actually not materially different to your structured yield products. And so you've got to be careful about the quality of the structured yield products that you buy. I have a personal favorite, and we're going to go into detail on those soon. But what we can see is that our full income focused products generally have high gross dividend yield, but a lower true total return. Structured yield products, broadly the same, and then we have our income-oriented value investing, which have a low dividend yield, which maybe to some investors is not exciting, but they have this growth potential, which over time is really interesting because that growth potential compounds into this 3%, and your income actually grows. And so there's some value, there is a case where you own these things, and over time they grow in value, which then grows the dividend, and then over time you can retire. And I'm going to explore that later in this video. So of the products that we've explored, I'm highlighting the products that we're going to use as examples to go through in detail using specific use cases. So these ones highlighted in pink, ALTI, QQQY, JPQ, and Divi. We're going to go into detail, and I'm going to try and explain to you the dynamics that I'm seeing, which generally cover and represent these products in each category quite well. So here is ALTI. Now, ALTI is a really interesting product because it gets promoted as this amazing diversified product that is exposed to all these amazing high volatile assets that generates a lot of income. But when we look at it, it's generating these massive dividends, but experiencing a tremendous decline in NAV erosion, which has suddenly changed tack a little bit in the last few months based on the fact that these products are broadly in line with the QQY, and the QQY has had a bit of a dip and then it's come back and recovered. And owning this product pretty much outside of April to August has generally sucked. And this NAV erosion is very characteristic of these normal covered call strategies, and I can show you that because we're going to look at another one that shows in the exact same pattern. So this is QQQY versus QQQ, or the NASDAQ 100 index. So this is QQQY, and it's showing you the exact same NAV erosion and then flattening out in April, May, June, July, September this year as a product of this bullish run in the NASDAQ 100. So this product issues covered call strategies at that aggressive income-oriented focus category of product against the NASDAQ 100. And what we can see is unless we're getting really strong upward movements, like this, for example, where we're seeing like nominally flat principal value or NAV, net asset value, or here where we get a strong upward movement through May through to September, and we get a maintenance of that NAV. Other than that, if it's only going up a little bit, we'll get this decline, and then if we're getting a drop, we're fully exposed to it and we go down, right? And this chart is a little bit distorted to the previous example because I've added the QQQ NASDAQ 100 index here to compare to help you understand what's going on. Now, what I can conclude is that ALTI as a product is generally trading on products that follow this NASDAQ 100 trend, and so I suspect of the 20-30 products that sit in the ALTI product, they're all basically drawn from the NASDAQ themselves. I can't say for sure. I'd have to go read the prospectus, but you can see it in the price action. So this product is the problem with some of these income-oriented products, is that their NAV erosion is so strong, and that when you truly take that high dividend yield and you pull it out from under the hood and you look at it, it's usually 15 to 20% income and 80 to 85% return of capital, which means that of that high dividend yield that you're receiving, about 80 to 85% of it needs to be plowed back into this principal value or this NAV in order to maintain the overall value of your investment to then generate that yield. And so really, with QQQY or Alti that are generating these, 80 to 90% dividend yields, you really have to multiply it by the income versus return of capital ratio, which, might be 15%, to get your actual income, which 15% on 80% is that sort of 10 to 14% range, right? And so it's not that amazing. So that's sort of one of my critiques of a lot of these high yield dividend income orientated strategies, is that their income is illusory, and we're going to explore that in more detail later. Right, so now that we understand that, let's deep dive into the structured yield products, which I'm using JEPQ as the example, and I really like it because it's really comparable to the QQQY and the Alti product because it's also based off that NASDAQ 100. And what we can do is we can compare it here, where basically the NASDAQ 100 has gone up and it's had all this capital appreciation, and the JEPQ has traded some of that capital appreciation for income. And so you can basically convert some of your NASDAQ 100 exposure into a dividend-like stock, but you haven't really generated necessarily incremental return because you've traded this compounded growth in for income, right? And so is it true income? Maybe, maybe not, and that's what we want to explore later in this video. But I'm going to just touch on this product very, very briefly because I wanted you to understand that this is like the mild version of Alti or the mild version of QQQY, and still gives you some of that upside while giving you some income, right? And that income is in that sort of low double-digit range, 12 to 14%. But it's an interesting product. I actually quite like it. And finally, we have the Divi versus QQQ and SPY. Now, this is the income-oriented value investing approach, right? And this product is really interesting because it shows you the typical characteristics of a diversified income-generating investment portfolio, where we've had SPY and QQY come down and then come up. Now, what we can see is that this Divi product has evened out a lot of this volatility. When QQ and SPY have come down, Divi has maintained its value through generating that yield. It's maintained its ability to be attractive to investors, but also when its when SPY and QQQ are running up, it doesn't have that same run-up potential, right? And this is why some of those income-oriented investments are used to diversify portfolios, because they tend to hold their values in a bit more of a stable environment generally. Now, this is a really, really typical characteristic of a lot of income investing in that typical boring equities, utilities, supermarkets sort of diversified income approach, is that you get slow, very steady growth with some income, but it is kind of interesting because it can be quite powerful and it can compound over time, and I'm going to show you why now. So we've got to ask ourselves, what is true income? Now, when we define income properly, we can stop getting distracted by these big, amazing gross dividend quoting in the market, and we don't go into our typical filtering and filter on highest dividend yields and just invest in all these high-yielding dividend products, because what we want to do is really, truly understand what income is. Now, let's define income for a minute. True investment income is income derived net of any capital deterioration in capital, whether through net asset value erosion or depreciation plus any necessary capital reinvestment, when monetary debasement is factored. And that sounds super complex, but the equation actually ends up being super simple. So let's do a couple of examples, assuming monetary debasement is 8%. But if you look at monetary growth or money supply growth over the last 50 years, it is broadly 7 to 8%. Now, true income equals the gross dividend plus the capital growth minus monetary debasement, right? So let's look at two examples. The Schwab, which has a 3.9% dividend, which you can look in the table in the previous slides, and an 8.4% capital growth since inception, and we exist in an environment of 8% monetary debasement. So the true income of the Schwab product is 4.3%. So we can draw 4.3% out of the Schwab, which is the 3.9% dividend, plus 0.4% from the principal, if we choose to, on Schwab as income, and the investment would retain its value when accounting for growth in money supply. So this is a really interesting concept. Now let's apply the same thoughts and same logics to Alti. Well, Alti generated a 91% gross dividend, but it had a negative 82% capital growth, which is not ideal. Now let's factor in monetary debasement of 8%. Wow. Alti generated 1% of true income, which means that you could only draw 1% out of Alti, and you'd have to reinvest 90% back into the principal into Alti in order for its value of the investment to retain its value when accounting for the growth in money supply. And so that is how we can stop getting distracted by all these amazing quotes of gross dividend, and we can just look at total return and factor in some monetary debasement, and then we know the true income of that product over a long period of time, right? So when we think about owning an investment for at least 10 years, this becomes really powerful. So to summarize our learnings from today, the high yield ETF landscape can be broken into three main categories: full income focus, structured yield, and traditional income oriented value investing. Much of the dividend income associated with these high yields ETFs is manufactured for marketing purposes. When you define income properly, you can isolate for the true income with a simple formula where high-yielding income products may in fact generate less income than low-yielding income products. If you apply this formula, the max income performance generally reaches 10 to 12% in line with higher risk income products, with the exception of the Misty Winter products, which I'm going to treat in their own video. This 10 to 12% represents the risk-adjusted income arbitraged out of the market. Misty and Winter and Coney and other Bitcoin-oriented ETF products present a special case where there's a valid thesis for being powered by a monetizing asset. In my previous video, we discussed that that's a narrow band of possible outcomes where it truly kind of does that. So we have to look at that with a bit of nuance. About me, I have an economics, finance, and accounting and engineering background, 15 years in corporate finance and corporate strategy, and I've developed my own active approach to overcoming that 10 to 14% dividend income barrier. So if you want to learn more, check out my website, mangosteen.global. Of course, I'm incredibly biased, but I have my Mangosteen Framework, which is a Bitcoin-focused approach, active strategy to generate yields of 30 to 80%. Income is Bitcoin denominated, so it's true income. Simple bullish bearish approach. You don't have to be glued to your screen. Trades occurs every 6 to 8 weeks on average. Check out my website, mangosteen.global, and there's additional 5% discount when paid in Bitcoin. So email me for details if you're interested in that. There is also a 14-day no questions asked refund policy. So if you want to check it out and you decide it's not for you, just flick me an email and I'll refund you, no questions asked. And of course, disclaimer, this channel does not provide financial advice or any advice of any kind. You must do your own research. Any investment or trading decisions you make are your own. This is entertainment only. You are listening to a random Mangosteen on the internet. Thanks for listening. I hope you enjoyed this Finance Bro episode. You can find me on X, YouTube, and my website, mangosteen.global. Come check me out. I've got some interesting ideas. If you have any questions, feel free to flick me in the comment section or flick me an email or hit me up on X. I will answer anything that you've got. Cheers. Thanks. Bye.